debate investors have been weighing is whether the economy is currently experiencing a soft landing or even no landing at all. It's a question that was posed to Bank of America CEO Brian Moynihan earlier on CNBC after the company's better than expected earnings. Take a listen.
From what we see and what our experts tell us, we took it's no landing might be the best choice if you're thinking it gets down about 1.5 to 2% growth, which is where it was sort of for a lot of years prior to the pandemic. If we can glide into that level and keep the inflation, which is down a lot now, continuing to move down, that would be a no landing.
All right. Well, joining us now is Mohamed El-Erian, Chief Economic Advisor at Allianz. Mohamed, it's great to have you back on the show. I want to get your response to what we just heard from Brian Moynihan, because I can't recall us hearing from a bank CEO that has such insight into so many different parts of the economy talking about no landing.
No, what he just said, Morgan, and thank you for having me, that would be a soft landing. That is, in fact, the definition of a soft landing. A no landing has two variants. One is that growth stays high and inflation stays high, and the Fed tolerates it. And by inflation stays high, we mean 2.5 to 3%. There's another no landing, which is the really good no landing, which you get positive supply shocks, and we are bigger but not hotter. And that has about a 15% probability of happening.
What would it take for that to happen?
I think we need the productivity enhancers from AI, from life sciences to come earlier. We need to continue to have positive shocks to our labor force. And if we get those two things, you can get the bigger but not hotter economy, which actually would be perfect for almost everything you can think of, from households to companies to financial markets.
I mean, no one's even really talking about recession anymore. It seems to have gone out the window and rather quickly here. So what are the key factors that you're watching through the end of this year and into next? I mean, inflation, for example, we just had Thomas Petterfy from Interactive Brokers on, and he basically said he doesn't think inflation's dead. Can we ring the victory bell on it yet?
No. So my probability of a soft landing is 55% and a recession 30%. So soft landing is the most likely, but it's not a dominant scenario. Why isn't it dominant? Because we have weakness in the household sector and the lower income side. And the Fed has been all over the place. Just think, Morgan, end of July, the Fed doesn't hike, doesn't cut, because everything is fine. Next meeting, mid-September, it suddenly cuts by 50 basis points. And now it is talking about cautious cuts. So, the Fed's got to be careful not to increase the probability of something going wrong. But soft landing is the most likely. The economy is strong, corporate earnings are strong, and on top of that, we have well-behaved oil prices, and we have the hope that China may stimulate the economy, helping to boost our demand.
The oil prices piece of this is particularly fascinating because we saw a jump in crude, and then we've fallen pretty quickly here as it would seem geopolitical risk is ebbing, not to mention you have an OPEC cut to the oil demand forecast. How much hinges on those prices staying a bit more depressed, which also seem to be, at least in trading today, pushing yields lower?
Quite a bit. High oil prices can complicate things. They would, of course, take up headline inflation, and then they would start feeding into higher production costs. In terms of where we've been, it's been about geopolitics. On September 10th, WTI was at $65 a barrel. Why? Because people were worried about demand, especially a weak Chinese economy. Next thing we know, we were all the way up to $77 a barrel on geopolitics. And now we're back down to just under 71 on geopolitics. So the geopolitics is the volatility enhancer. The underlying price of oil is being undermined by weak demand out of China.
How much hinges on the election and what the policy picture starts to look like for 2025 and beyond?
So the market's pretty relaxed right now about that, because it believes that the configuration of Congress and the White House will be such that policy will be more constrained than what we hear on the election campaigning. So a lot of it has to do with what happens to Congress and whether whoever's elected has a free hand. Where the two candidates differ, on the one hand, former President Trump on tariffs, and on the other hand, Vice President Harris on industrial policy. That's where the big difference is.
So just to bring this full circle, because we did talk about the Fed just a few moments ago, but we have gotten quite a bit of Fed speak in recent days, and some of it does seem to be tilting a little more hawkish. It raises the question, is the Fed too data dependent?
Oh, I've said this, Morgan, for I don't know how long. It is excessively data dependent. I'm hoping that they're starting to be a little bit more strategic because they're being whipped around by the data. But they have been excessively data dependent. And what has happened in the last few months shows you that. And I suspect that given the latest data, they wish they hadn't cut 50 basis points. They wish they had cut 25 basis points. And that's why you hear the language getting more hawkish, because the last bit of data has not been supportive of the 50 basis points cut that they made last month.